So today, let me see, is April 14th. Tomorrow's tax day. Everybody file their taxes? Got them done? Income taxes? Yeah? Okay. Good deal. Gosh, I remember when I was practicing for many, many years, I got to April 14th, I was starting to feel pretty good. But I would have worked 2 12-hour shifts probably over the weekend, and would be the 14th would be another 12-hour. I enjoy doing taxes. I enjoy the work. It's hard, like when you got kids and a family, it's a really hard thing to do, but you kind of get in the groove during tax season, and it's fun to meet with clients and everything. So there are things that I do miss about it, but I don't miss the 80, 90-hour weeks. So I enjoy this job as well. So that helps when you go to a different job that you also enjoy. All right. So today we're going to look a little bit more closely at Iowa SUTA. I'm going to show you, I got a couple of links up here that gives you more information about how Iowa processes unemployment insurance, or how they assess the unemployment tax. We're going to take a look at the Iowa SUTA form as well. And then we're going to probably finish up the slides today. And we'll start that process by talking about this experience rating. You've got a homework problem, or you should have a homework problem. Actually, each of you has different homework problems. So I assume, though, that you each at least have one that addresses this issue. At least that's how I set it up. Hopefully you do. This whole concept of reserve ratio, what the experience rating is how states will assess what the future tax rate is going to be for individual companies. So I'm going to kind of go through that process. It's a calculation. It can be a little bit cumbersome, a little bit confusing, which is why I wanted to go through the homework problem with you. So that's that. And then we're going to take a look at the Form 940, which, remember, is the annual form that is used to report federal unemployment taxes. So up here, we're talking about the form that reports state unemployment taxes and what should be assessed. This is the form then that reports federal unemployment taxes. This is an annual form that is filed, and we'll take a look at that. Look at it kind of line by line. Those deposits, which we've already discussed, how the deposits are what the rules are for the deposits. Remember, you don't have to make a deposit until either your liability reaches $500, or it's the end of the year and you have to file that 940. So whichever one of those comes first is when you make the deposit. So if your liability during the year never exceeds or reaches $500, then you don't have to make the payment until you file the 940 form. And I guess this is kind of we're already discussing this up here, so that's kind of a duplication. So that should get us through the day. Just real briefly, on Thursday, I don't have any more lecture for Chapter 5, but what I want to do is I want you to look at your homework and come to class with any questions that you have, because we do have some time for that. So if there are any specific homework problems that you are struggling with, I want you to attempt them, of course, but bring them to class and we can look over them, because chances are if you're having a problem understanding it, somebody else probably is as well. So try to get to those Chapter 5 assignments before class on Thursday so that I can answer any questions that you may have. Also, what we're going to do, I have a little practice quiz just to kind of review Chapter 5. So we'll do that. It's not too big a deal. It's just a review quiz. And then I want to spend some time on Thursday looking at Chapter 7, this payroll project, because you're going to want to get started on it. Like I said, at first it will take you some time, but once you get the hang of it, it won't be that bad. The good part is it actually does a lot of the calculations for you. So you're not having to, even though it's like processing payroll, even though you're entering the information in, it should, as long as you enter the information correctly, it should produce the correct withholdings for you. So you're not having to do that on an individual basis, but it's just to give you some practice and a little bit of exposure to what that may look like as far as entering payroll in the software. So I've got some time set aside on Thursday to start looking at that. Next week, we'll start with Chapter 6, our last, Chapter 7 is our last chapter, but it's no lecture material, no new material. It's just working on that payroll project. Chapter 6 is when we're going to look at how we integrate all of the information we've calculated into the financial accounting system, and we'll get started with that next week. Any questions right now before we talk a little bit more about Iowa? No? All right. So let's take a look. So Iowa Workforce Development is the agency that oversees the unemployment program in the state of Iowa. So they have, and this is their website, so just Iowa Workforce Development. This isn't the home page of it. You can see there's lots of different, the information that's on this website is both for individuals who have become unemployed and are seeking benefits, as well as for employers who are required to provide the unemployment benefits to employees. So that's what we're going to want to look at it from that perspective, the perspective of an employer who has obligations to report earnings and pay those unemployment taxes. So and so they give you a little bit of rundown about how it kind of works. So unemployment tax payments are deposited into a trust fund, into a general trust fund. It's set up, each business has its own account. So the account is credited with the tax payment. So kind of like when Social Security is withheld from employee paychecks, and then their Social Security number is attached to deposits that are made on their behalf. Everybody has their own account. So each employer has their own account. And the account is charged for all regular unemployment benefits and 50% of extended benefit payments to former employees that are qualified. So I don't have information on what those extended benefit payments are. For our purposes, really right now, we're concerned with, how that account is charged for regular benefit payments. So that any amounts that are coming out. Charges to your account are used in order to determine your rate, which is what we're going to talk about, which is that contribution rate and the calculation of what we call reserve ratio. And we're going to go through that calculation today. Each account is assigned it's called the North American Industry Classification System. That NAICS number is used to classify what type of industry the employer works in. So like if it's construction contracting, or if it's a CPA firm, or if it's an online retailer, or if it's a grocery store, like every single different type of business has its own, NAICS number, NAICS number. And these are used on tax returns as well. So if you have if you're an independent contractor and you file a Schedule C with your income tax return, I don't expect you to know what that is, but if you do that, your business has its own number, and it would be the same one. So they base some of their what the rate is going to be partially on what industry you're in. Remember, we talked about how certain industries have higher turnover rates, and so they are naturally going to have higher unemployment tax rates as a result of that, because there's going to be more use and more claims filed against them. So again, using this classification to determine if somebody's in the construction industry or the non-construction industry, as well as different types of industries. So this is, and it's really small, I know it's kind of hard to see it. Let me see if I can make it a little bit bigger here. Yeah, it's a little bit better. So this is, over here to the left is a ranking system that I don't know the details of who is at what particular rank or what their cumulative taxable amount is, but the unemployment system will apply this table to determine what a tax rate is. So these are different, I think these are different industries. And I believe this first one is probably construction, because you can see it goes up to 9%. Most companies are going to fall in this category 8. And you can see what we talked about when we saw in the book, that tax rate ranged from 0 to 7%, which is what we see here on the table. So it's going to correspond, your tax rate is going to correspond. They're going to enter a bunch of data and decide that you're in what your benefit rank is. And then from that, they're going to determine what your tax rate is for unemployment benefits. So new employers, what happens when you're a brand new employer? New non-construction employers are assigned the rank from rank 12 of the table. So if you look at rank 12 here and you go over, whoops, where is it? From rank 12, I don't know how that's working then. From rank 12 of the table, or 1%, whichever is higher. So based on the industry that they're in, again, these are different categories of industries, it's going to be either one of these tax rates or 1%, whichever one is higher. So you would automatically have at least a 1% tax rate in your first year, once before that you've like established a history with the agency. New construction employers are assigned the rank of 21. In effect, they say the rate for 2025 is 7%. So you can see the difference there between construction and non-construction. So this would, everybody non-construction, they're going to be at least 1%, but probably not higher than whatever the highest rate is, 3%. But construction is going to be at 7% in that first year. So there's a formula for determining the tax rates of individual employers. In the benefit ratio system, 2 factors are calculated. Employers' 5-year average annual benefit payment, so the amount of benefits that have been paid out on average over the last 5 years, divided by their 5-year average annual taxable payroll. Now you're going to see when we go through this this contribution ratio calculation, it's a very similar type of wording. The result is benefits expressed as a percentage of taxable payroll or a benefit ratio. That's what we're going to be calculating here. Each employer's benefit ratio is compared to every other employer's benefit ratio in a ranking or an array system. Those with lowest benefit ratios receive the lowest tax rate. So if you think about it, you take the benefits that are paid out divided by the 5-year annual taxable payroll. So the higher your benefits, that's increasing the benefits that have been paid out. That's increasing the numerator in the calculation, which is increasing the number. So that means that the ratio is going up. The converse, the fewer benefits paid out, the lower the denominator, the lower that benefit ratio is, and that's going to result in lower tax rates. Okay, just kind of a visual expression of that. So your rank is determined by how your benefit ratio compares to the benefit ratios of other employers. Each employer's rank is calculated, listing their increasing benefit ratios from the lowest to the highest. Employers are divided into 21 groups or ranks. That's what's on here. These are the rankings. Each of the 21 contains approximately 4.76% of total taxable wages reported by the same types of employers. So currently, approximately 44% of Iowa's ranked employers have a 0% rate. So that means they haven't had, if you've got a 0% rate, that means you haven't had any claims against you. There's no turnover in your company. Maybe it's a very small company, or maybe people who've left haven't qualified for claims, because you do have to qualify in order to receive unemployment benefits. And if you can't quit and get unemployment benefits unless you could prove that somehow you were in a hostile work environment or you were forced to quit or something like that. But you can't just leave your job to go to another job and then, or leave your job, seek other employment, and then get unemployment benefits. You have to be terminated for that. And you have to be terminated. You can't, if it's because of your own actions, like you were a bad employee, you didn't show up on time, you didn't do your work. If you're terminated, that is for cause, and then you don't qualify for unemployment benefits. So essentially, those unemployment benefits are available, and that's a generalization. This is a highly litigated area. There are a lot of people that will will hire an attorney to get these benefits for them. So nothing is absolute, but in general, you have to have been terminated without cause. Maybe you've been laid off, maybe it's seasonal, that sort of thing. But 44% of Iowa's employers have a 0% rate. That means they have no claims against them. They send a notice of rate in November of each year for the following tax year. So November 2025, employers are going to get a notice from Iowa saying, in 2026, this is what your tax rate is going to be for unemployment benefits. So these rankings, and they don't, if I remember right, these things, they don't really say what rank you are. I mean, they might, but most employers wouldn't know what that meant anyway. They just tell you what your tax rate is going to be. So we'll look at the report that's filed with Iowa. It's filed on a quarterly basis. So unlike with the federal return, which is filed annually, the Iowa unemployment form is filed on a quarterly basis. So at the same time that you're doing your 941s and your forms for state withholding, you would be filling out your unemployment forms to send into Iowa. And it's at that time that you also pay the taxes. So you don't get the benefit with the state of waiting until the end of the year. Remember, those amounts are going to be a lot higher than the federal unemployment amounts, the FUTA amounts. So they want their money a little bit faster. You can appeal the rate that you are given. So if you don't agree, if the employer does not agree with the rate, they think it's too high, they're not going to appeal it if they think it's too low, right? But if they think it's too high, you do have the right to appeal it. And they talk about the grounds here. So if there was an error in the rate, so like if they think that, nobody's filed any claims, but my rate went up, well, that would indicate that there's an error. Your rate shouldn't go up if none of your employees filed any claims over the last year. So that would be one way that you could get one ground for an appeal. Grounds do not include financial hardship, as we cannot reduce rates that are correctly calculated. So if you simply say, well, we can't afford this, that's too bad. You have to figure out a way to afford it. So a taxable wage base, which we talked about a little bit, the numbers in your book were from 2023. These are from 2025, actually 2024 and 2025. So I think, does anybody remember off the top of their head what Iowa's rate was in 2023? What's in the book? I can't remember off the top of my head. We did some calculations based on it, but I still don't remember. But anyway, currently the wage base is $39,500. So it means that amount of wages is going to be subject to whatever rate the employer has been issued. Let's see. Benefits paid are generally charged to the accounts of the claimant's base period employers. Most recent base period employer is charged first with benefits paid until the wage credits are exhausted. I'm not even sure what exactly that means. like I said, I don't know much about the benefits and how they're paid out. We're really mostly concerned with those taxes and how the taxes are collected. Base period, 4 quarter. We don't need to go through any of that stuff. All right. So within 40 days, the Iowa Workforce Development sends each employer a statement of charges listing the amount of benefits that were paid to former employees and charged to their account. So if you have employees who have made a claim against, employees that were terminated that have successfully made a claim and received benefits, the employer, the former employer, is notified of that. They know what those benefits are. So they send out statements. If you owe them money, they will send out a statement to the employer. What else do I want to say? So this is just stuff about the federal unemployment, which you guys should know all of this stuff. Food tax, 6% of the first 7,000. Of course, you get that credit here. Due to the ongoing solvency of the UI trust fund, so that means Iowa is solvent. We do not have any outstanding loans that we've taken from the federal government. That means that all employers in the state of Iowa, as long as they themselves are current on their individual SUTA taxes, they're going to receive that full 5.4% credit. So that's what that's talking about there. Applied to all accounts, making the tax rate 0.6% for FUTA purposes. Let's see. So that's just kind of a rundown of how Iowa does it. Now let's take a look at the form that is used in Iowa. Let's see here. All right. So you can see up at the top, every employer is going to have their own account number. You need to indicate what quarter you're filing for, what the year is as well. All of the identifying information for the employer is here. That FEIN is the Federal Employer ID number. We talked about that early on. Each employer is issued a federal ID number. It's like their social security number. So that is used on this state form as well to help identify them. So some of these things that would be already filled out, this would be filled out for the employer, these percentages. That would be indicated for the employer. This is a fillable form, and it's just kind of a template. So it's not filled out, but that would be already filled out for the employer on these forms. These are filed electronically, by the way. Every employer has their own account. So every quarter, the payroll department would go in and fill out all of this stuff. Now, one of the things you actually would, when you're filling this out, you start with page 2, because this is where you have to list every single employee. Now, there are ways that you can upload the information to these forms. Like if an employer has hundreds of employees, that's a lot to be filling out and a lot of pages that you're going to have to go through. So you can have a file that you upload where you upload all of this information, and their system works with a lot of different payroll software, so it can be uploaded fairly easily. But the information that you're sending, employee's social security number, employee's name, full name with their middle initial, the total wages that were paid during that quarter that's referenced, and then the taxable wages that were paid. So if the employee has not reached that $39,000 in 2025, that $39,500, then all of their wages paid would also be taxable wages. If that individual employee has reached that $39,500, then the total wages paid would be more than what the taxable amount is, right? Because once they reach that threshold, they're no longer considered taxable wages for SUTA purposes. So all of this information is entered for each individual employee, and then everything is totaled. And of course, if you need more pages, that is available. And all of it is summed up here. So total wages, so that first column, all of it in total there. Taxable wages then, that second column. Experience rate, that's our tax rate. When it says experience rate, that's our tax rate. Okay, because it's not really officially a tax, it's kind of an insurance. So, I mean, we call it tax, SUTA, state unemployment tax, but it kind of blurs the line of whether it's a tax or an insurance because it's directly providing these benefits. But when you see that experience rate here, that's the tax rate that the employer has been assessed. And again, it's going to be either somewhere between 0 and 7% for in the state of Iowa. Here, you multiply the taxable wages times the experience rate. Reserve fund owed. So if there is an amount, if the employer is overdrawn, they can make a contribution into the fund in order to bring them back up to so they don't have that liability anymore. If there's a surcharge, and that would be over here, and it would have been already calculated by Iowa Workforce Development when they sent out this form. So if there's an amount over here, the calculation would be here. So reserve fund owed, the percentage rate, whatever that is, we're going to again take the taxable wages times that reserve fund rate. If a surcharge is owed, so that rate over here, we would multiply the taxable wages times that surcharge rate, add all of them up, and this is the amount that's owed. If there's any interest owed, and they do give you a calculation, well, I guess there's no calculation for the interest. There's a calculation for penalties. So if you're late, and you don't want to be late, because remember that then also means that you're going to lose some of that federal credit. But if you are late, there is a late delinquency penalty rate that is then calculated here. So how to calculate the interest due? There's the calculation. So multiply the amount that's owed, line 6, by this percentage, round 2, multiply that number by the number of days late. So on a daily basis, this is the amount that gets charged, the percentage of the amount that's due. So you can do your own calculation there. Add all of it up. If you still have any amount due from the last time, you'd add that in. If you had a credit from the last time, so maybe you've overpaid, you can apply that here too, and then the total amount due, and then the amount that you have paid, or the amount that you're paying, listed there. What else do I want to say? Oh, there was another part down here. This is just kind of information gathering by the unemployment, by Iowa Workforce Development. So they want to know the number of employees that worked or received pay for the pay period that includes the 12th of the month. So kind of like that question on the 941, remember the very first question, how many employees did you have on this particular date that were paid during the pay period that included this date? This is the same thing, but it's broken down by month. Okay. Amount of pay which exceeds regular and recurring payments. So bonuses, executive pay, severance pay. So anything out of the ordinary, they want to know how much of the amounts that were included up here in wages is due to unusual payments, right? And then if the number of workers increased or decreased during the quarter for any of these reasons, they want to know about it. So like if you went from 10 employees to 1 employee, they want to know, well, why? Why did that happen? If it's for one of these reasons, you would check it. So seasonal change, maybe it's just, it's the nature of the business that they would have some sort of change. Labor dispute, so if people were on strike, right? If there were layoffs, or if people who were laid off were recalled. So maybe you had 1 employee here and then it went up to 10. So there was a layoff earlier, but those employees were recalled. You just opened a work site, so now you're increasing your workforce, or you're closing your work site as well. So if it's for any of those reasons, they want to know that. So like I said, that's just kind of a little rundown of what Iowa does, how Iowa reports these amounts. Now, and the amounts then are paid at the same time. Again, they're paid electronically. When you file the return through your Iowa Workforce Development, as an employer, when you file the quarterly Iowa Workforce Development form. You do all the calculations, and then you also remit the payment at the same time. Okay, and these are due by the last day of the month following the quarter end. Iowa does all of their taxes that way, by the way. Remember, with the federal government, a lot of those payments are due by the middle of the month. For Iowa and some of the reports are always due at the end, but like the payments are due at the middle of the month. Iowa always has their payments at the end of the month. Income taxes as well. So if you did just do your income taxes and you owe money to Iowa, it's not due until the 30th of April, not the 15th like the federal government, but at the 30th. So these are the dates and that's due. Okay. Any questions?
There's more of a personal question.
Mm-hmm. Yeah.
So for that, with Iowa taxes and everything, when you already file it, do they already like take away the money from your account or like give you the money, or it's like until that day?
So this is, you can set it up however you want. Like when you're filing, you can tell them if you owe money, you can tell them to automatically debit it from your account on that date. Like that's through software. Yeah. You file your tax returns, which is due tomorrow. So if you have a tax return due, you'll want to get that done. Well, the federal return is due tomorrow. State return isn't due until the end of the month. But did that answer your question? Kind of.
Still kind of concerned. I'm like, how can I set it up so it's like already paid? Because like I don't want it to be like, oh, let's do it like at like the day of. Like I'm just like, oh yeah, like I just want to get it over with.
Yeah, you can do that too. You can absolutely do that too on the software. It'll give you. It should ask you. I mean, I'm not familiar with like the individual softwares because I use like the ones that the businesses use, but I know at least our software always would ask you, well, what date do you want this money to come out? You could do it immediately so that you know that it's out, or you can wait until the last day and then make sure that the money's in there in order to get that taken out. But for the refund, you don't have that option. They pay you when they pay you.
They pay you whenever.
They pay you, yes. And apparently Iowa is taking a little while this year. They say it's because they're more closely examining returns for fraud. I don't know whether that's the case or not. But yeah. Any other questions? Okay. So you don't have, don't worry, you don't have any specific questions about Iowa on the test. There are, yeah, you don't have to fill that out. This is just, I need to show you how Iowa does it so you're just familiar. So if you go into the workforce, you're not like, oh, I've never seen one of those before. You at least know exactly, what generally what you're talking about here.
So when you file your own taxes, you have to set up like with meeting up with tax professional to file taxes?
No, you can do it yourself. And there are a lot of the companies, I think TurboTax, H&R Block, they've got Free File. The only problem with the Free File is, and this is, I've learned this from people who've tried to do this, they're very limited on what forms you can use. So like I know TurboTax, I think it's if you qualify for the earned income credit or the child tax credit or the additional child tax credit, you can use those forms. You can free file, they're not going to charge you for it, but if you have anything outside of that, so like if you had, and I don't know if the Schedule 1's included, but there's a credit out there if you contributed to a retirement account and your income is below a certain level, they'll give you a tax credit for that. If that's the case, then you no longer qualify for the free file, and then they start charging you for the additional forms and this, that, and the other. So it's very narrowly tailored to only certain, and you have to have income requirements as well.
I started doing the taxes before I ended at 4.
Yeah.
And mom was just like, "You're still doing taxes?" I'm like, "Yes." I'm trying to read everything so perfectly.
Yes. Yes. Yeah. So you can do it on your own. I mean, you can get and I don't know if there's even, well, I would suggest going to, like, IRS used to have free file. I'm not sure they do anymore. The problem with it with the IRS was it's only the federal form. It's not the state form. And so if you'd still have to do your state income taxes. But those other ones, like if all you have is a W-2, well, I shouldn't say that, because even if you contributed to a 401k or something through your W-2, you wouldn't qualify for it. But if you have fairly simple return, there's a pretty good chance that you could qualify for that free file with one of those companies. But there's also a chance that you get through it. Like I had a friend of mine, his daughter, this was just recently, his daughter tried to do that, and then she qualified for the retirement income credit, which was going to get her an extra $200 back, but they were going to charge her like $180 because she had the extra form, and now she's got a filing fee and this, that, and the other. And well, she would have, yes. But that answer your question? Okay.
So mostly, like, usually, like, they would do it on their own and go and stop.
I don't even know what the percentages are, what the data is on how many people hire somebody versus how many people do it on their own. They can be a lot more. You think it's easy, and then you kind of start getting into the weeds a little bit. One of the options is the VITA program. So the Volunteer Income Tax Assistance, which if you haven't done your taxes yet, you can contact them. There's actually an office. They have several offices around Des Moines. If your income is under $67,000, then you qualify. You can go in there. Some of them you have to make an appointment. Some of them you can drop in. But they will do your taxes for free. And they'll do it. There's no limitation on the forms or anything like that. But you sit down, you fill out a form with all your information, and then you sit down for an interview with an individual, and they prepare that while you're sitting there so that they can ask you any questions that you have. But there is no charge for it. So, and like I said, if you haven't done your taxes yet and you need to get them done, I would suggest maybe looking there first. VITA, so VITA, Volunteer Income Tax Assistance Program. Okay, so you just take your forms there, you need your ID, and so you need a driver's license or state ID and social security card, and all of your tax information, so your W-2s, 1099s, all those forms. Okay, all right. So you kind of get the best of both worlds there. It doesn't cost you anything, but you're getting somebody who has been trained in tax preparation. And many of those people, they volunteer every single year. So they've got a lot of experience. And there's always a supervisor there as well. So it's an excellent program to help you out. All right. So let's look at this experience rating thing. Are there any other questions before we talk about that? Okay. All right, so we talked about a lot of this stuff here when we looked at Iowa specifically. And in the Iowa information, they talked about experience rating. So the experience rating reflects the stability of an employer's employment history. So what's the turnover like at that company? Do they frequently fire people? Are there a lot of layoffs? Or is it pretty stable? Remember that whatever their experience is going to determine what their future tax rate is. Lower employee turnover gets you a lower tax rate. Just like any other insurance. You don't crash your car, your car insurance rates are going to stay the same. They never go down, but they're probably going to stay roughly the same. You crash your car and your rates are going to go up because you're going to file a claim in order to get your car fixed. The most common formula is the reserve ratio formula, which is what Iowa said that they use. So the reserve ratio is calculated by taking the contributions, so the amounts that the company has contributed over time, minus the benefits that have been paid out over time, divided by the average payroll. And that average payroll is going to be, like for Iowa, they said they take the last 5 years average payroll. Some states may take a different average payroll. I think in our example, I think it's 3-year average payroll. So reserve ratio equals our contributions paid, right? Minus, or actually, benefits paid divided by our average payroll. And again, that might be the average over 3 years, it might be the average over 5 years. What happens is we take this, once we have these amounts, we take that reserve ratio and we apply it to a table. That table then tells us what the tax rate is going to be. So the contribution rate, computing the total reserve that's been built up by the employer contribution over time. So if you think about this, contributions paid, how much have you deposited, minus how much has been withdrawn, is the amount that's still in the fund, right? So if you've contributed $10,000 over this period of time and they paid out $5,000 in benefits, you've got $5,000 left in the reserve. We divide that by what the average payroll is. That gives us our reserve ratio. Positive balance employers will experience lower tax rates because this means that the employer has built up a balance in the reserve. That makes sense. So if this up here ends up being a positive number, you're going to have a positive reserve ratio and you're going to have a lower tax rate because you still have money in the bank essentially, right? If it's a negative number though, if they've paid out more benefits than the amount that the company has contributed, well, now they're in the red. They've got a deficit in their reserve. This is going to be a negative. This is going to increase their tax rate. Okay. Let's see here. I'm going to go through. I just don't know if they give us an example here. Okay. So, and one way that employers may be able to reduce their tax rate is if they make some voluntary contributions. So instead of just paying the taxes that they're due, they're gonna pay in something extra in order so that maybe this was a negative amount before. So let's just say that our contributions paid were $10,000, but our benefits paid were $12,000. Well, that would get us a negative $2,000, right? Well, if the employer then pays in that $2,000, they make an additional payment, we'll bring this up to zero. Employers can do that. They can make an additional payment in order to get themselves a better tax rate. Okay. Terminating a liability. So an employer remains liable for 2 years after an employee is no longer employed, so they can still make claims. To terminate the liability, employer must file an application, and each state law is individual in that. Let's see. Nonprofits have the option to reimburse the state for the actual amount of benefits instead of paying a percentage. So nonprofits can, if they have an employee who is terminated and they're going to be filing, they get $12,000 of benefits over the next, well, it probably wouldn't be $12,000, but say $6,000 of benefits over the next 6 months. What the nonprofit can do, instead of paying a tax rate, they can just pay that $6,000. So just kind of like being self-insured. Pseudo Dumping Prevention Act. So this is an act that requires states to have laws that stop businesses from lowering their unemployment rates by forming new companies. So if you can imagine, you've got a company that has a really high turnover rate. You've had a lot of employees that have it qualified for unemployment benefits, and they've received unemployment benefits, and your rate is really high, your tax rate is really high, and you don't want that tax rate anymore. So you shut down your company, and then you just open up another company. File new articles of incorporation, get a new taxpayer ID number. It's the same company. Nothing's really changed. The only thing is now you're going to start out at a lower tax rate because you're a brand new company. So maybe you had a 5% tax rate before, and remember for Iowa it said essentially it's about 1% to 3%. This is a law that prevents you from doing that because essentially that's cheating, right? You can't just close down your business, open up a new one, and get a new rate. Okay, so that's what this Pseudo-Dumping Prevention Act is. States are required to have laws that penalize that type of behavior. Okay. Let's see. Okay. So it's 1:40 right now. I want to go through this calculation to show you how this works. I want to keep this up here, but I want to do it in a smaller way. I just need this to be smaller. This one involves quite a bit of calculation, so you might want to follow along. And I'm pretty sure you all have at least a similar one, but the numbers are probably different. I know Cengage regenerates these problems and gives you kind of different numbers. Can everybody see that? There we go. Okay, so we've got Carlson Software Company located in State H. Employers can reduce their contribution rates under the experience rating system. So that means they can pay additional amounts to get their tax rate down. From 2010 to 2019, the company's total contributions to state unemployment amounted to $14,695. I'm going to write this down. So from 2010 to 2019, contributions were, what's that number? $14,695. We're going to need this number because we have to know what total contributions paid are. For the calendar years of 2020 to 2023, the contribution rate was 2.7%. Contributions for each employer are credited to an account. We need to know this because, so they've given us how much was contributed up through 2019, but we're going to have to calculate how much tax they paid in 2020, 2021, 2022. Yeah, 2023. In order to figure out additional contributions. So they can't just make it simple for us. They're not just going to give us the number, the total number. They're going to make us calculate some of it here. Contributions for each employer are credited to an account maintained by the State Unemployment Compensation Commission. Account is credited with contributions paid into the account by the employer and is charged with unemployment benefits that are paid from the account. So starting January 1st, contribution rates will be based on the following tax rate schedule. Okay, so this is the schedule here. What we want to do is we got to calculate what our reserve ratio is. Here's our calculation, reserve ratio, contributions paid minus benefits paid divided by average payroll. Once we get that number here, we will apply it to this table, and that will give us what their percentage is, what their rate is. So we've got to figure out what this number is. I think they give us the benefits paid somewhere. And we got to figure out what the average payroll is. Annual payroll for calculation purposes is the total wages payable during a 12-month period ending with the last day of the third quarter of any calendar year. Okay, so for annual payroll, we start with the fourth quarter and we go to the third quarter. Okay, so 13, so if we're looking at total payroll, now we've got total payroll and we've got taxable payroll. So we've got two different columns here. But we start with the fourth quarter. We don't do this as one year. We start with the fourth quarter and go through the third quarter. Average annual payroll is the average of the last 3 annual payrolls. The SUTA tax rate for the year is computed using the information available, benefits received and taxes paid as of September 30th of the preceding year. Okay, so, and we go through, so this is actually 2022. So 2019 would have started in 2019 and ended in the third quarter. So what we're going to do is start in the fourth quarter here. The schedule below shows the total payroll and the taxable payroll for the calendar years of 2020 to 2023. Now, when we're figuring out average annual payroll, we're going to use the total payroll. But when we have to figure out the benefit, not the benefits paid, but the additional contributions that have been made during this time period, we would use the taxable payroll to calculate that. Because we need to know what tax was paid, right? And so it's going to be the tax, and that's our contributions. Yeah, so that's our contributions. Unemployment benefits became payable to the company's qualified unemployed workers on January 1st, 2010. Between that time and September 30th, 2023, total benefits amounting to $15,100.90 were charged. They're giving us that number. They've given us this number here. So we've got minus 15,190. Did I get that right? Yeah. Okay, so we know that. But we've got to figure out this, and we've got to figure out this in order to get that reserve ratio. All right, what is the contribution rate for 2024? Let's go through this, how this works. So in order, let's first look at the contributions that were paid. So we need to figure the taxable payroll for each of these years. So for 2020, this is kind of hard to, once again, they don't give me enough. 15.90. All right, so I'm going to go do that calculation down here. Okay, so for our contribution, we're going to look at 2020. We're going to take our taxable payroll for each of these years, and then we're going to average it. They want our average payroll over the last 3 years. So for 2020, we had 12,500 plus 11,000 plus 11,400 plus 12,400. We're going to add all those up. 2021, we've got 12,200, 13,000, 12,700, and 12,000. And for 2022, or I guess 2023, whatever they're calling it, we've got 13,750, 10,000, 9,300, and 9,350. All right, so we're going to add all of these up, and then we're going to average those 3 years. So good. $47,300. $49,900. $42,400. Add those up. And we're going to divide that by 3. So 139,600 divided by 3. 46,533.33. Let's see, what's it telling us about rounding? Round amounts to the nearest cent. All right, so 46. Did I get that right? Did anybody check my math? All right, so that's our average payroll. We've got our denominator here. 46,533.33. Now we've got to figure out what our total contributions have, what our total contributions have been. No, wait a minute. Did I get that right? Oh, I used the wrong numbers. Dang it. Okay, sorry. Well, wait a minute. I can still use this. Okay, does anybody see what mistake I made? So I'm looking for, for contributions paid, I need to use the taxable payroll. But I just use the taxable payroll to figure out the average payroll. Does everybody see what mistake I made? Okay, so when we're figuring out the amount of taxes that were paid, they've given us the tax rate. Remember, our tax base times our tax rate equals our tax. They've given us our rate, which was 2.7%. They gave that to us in the problem up there. We have to figure out what that tax base is. That's what I just calculated here. This is our tax base. So this is not our contributions. I can still use this information. This is going to be our contributions paid. I looked at the wrong column. I was looking at this column. I should have been looking at this column for the total payroll. But that's all right. We can still use this information. Because this will be our base, our tax base. That's the total amount of taxable payroll that we had during those 3 years. And we'll multiply it by our tax rate, 2.7%. They gave that to us in the problem. We didn't have to calculate that. So 139. So 30, did I get that right? 139,600.027. 3769.20. All right. They told us how much was paid from 2019 or 2010 to 2019. Now from 2020 to 2023, this amount was paid. We're going to add those two together, and this will get our total contributions. Plus 18,695, 18,464.20. Contributions, total contributions paid were 18,464.20. So for the contributions paid, we're going to use our taxable wages times the rate. And just, I'll show you, I'll scroll back up so you can see where they gave us the tax rate, if you don't recall, right here. Contribution rate was 2.7%. Okay. Now what we have to do is I got to get the right numbers here. So this is our contributions paid. You're welcome. So now what we're going to do, we've got to get our average payroll. I didn't think that number looked right, actually. All right, so here, now we're taking our average payroll. Now we're going to use total payroll. So, but we're going to start with the fourth quarter there, 13,000. I think we're going to start with the third quarter. Let me double check on my wording here. Annual payroll, total wages payable during, ending with the last day of the third quarter of any calendar year. Okay, I'm just thinking I may have, okay, I need to do one more thing. So what I did, when we're talking about figuring out the average payroll, that's when we're starting with the fourth quarter. Let's see. September 30th of the preceding year, average. Okay. I may have made one other mistake, but I'm going to go through and see if I have. I may have, like, for the taxable payroll, I'm wondering if I need to, I don't know if I start with the third quarter again, or the fourth quarter again. We'll find out. If I'm wrong, then that's probably where I made my mistake. Okay, so for this one, again, annual payroll for calculating purposes, total wages payable during 12-month period with the last day of the third quarter of any calendar year. So here, we're going to start here, 13,000. 11,000. 11,500. 12,750. 2021, I think 12,500. 13,000. 12,750. 12,200. And then we're going to take 14,000. 10,9,390. 93.50. Okay. Now let's add these up. So 48,250. Okay. Yes. Mm-hmm. So I'm starting here because it tells you to annual payroll is the total wages payable during a 12-month period ending with the last day of the third quarter of any calendar year. So that means we're starting with the fourth quarter. So this is where I'm getting like the 13,000 and then the 11,500, 12,750. And then I'm going to start with 12,500, 13,000, 12,750, 12,200. Is that okay? And then I'm going to add these up and then we're going to average the three. All right, so 450. Oh, too big. $42,650. So 141,350. And then I'm going to divide it by 3 to get our average of those years. 47,11667. All right. Okay. If I have made a mistake, I will tell you, I know exactly where it is. It's in here. Because I didn't include these 3 taxable payrolls because I was starting from here. I may have needed to start from the top, but let's see. All right, so we've got 18,464.20 minus 15,190. Whoops. Actually need the calculator to do that. Minus 3363.30. 30 divided by the 47,116. 0.07138. That's the number that we apply to the table. So this is in a percentage. So 7.13 or 14% is between 0 and 7.9. So by using these numbers, I get 7.14%. That means that our contribution rate would be 5.5%. Let's see if I did it right. I have a feeling I didn't. Nope. Okay. So what I need to do is I need to add into our contributions how much tax was paid on these, because I included everything else here. So from 2020 to 2023, this amount is wrong. So, oh shoot, I should have just... Does anybody remember what that number was? Okay. 0.20. Okay. Because all I should have to do is take the taxable payroll for these 3 quarters and multiply it by 2.7% and then add it to that. It is. That's why I'm going through it with you, because this is the problem that most students kind of struggle with in this. I think there's only one problem like this on the homework. So $36,000, I was missing $36,000 of taxable income, so I'm going to add that in. So plus 972. So 37, 47, 41, 20. Now we're going to add those two together. 19,436.20. So let's make this. So that's our contributions. This is how much we've paid in. So we figured out our tax base, multiplied it by our tax rate over time. They gave us 9 years worth. We had to figure out the other few years. So 19,436.20. Gonna be that. Minus 15,190. 4335.30. Okay, divided by 47,11667. 9.2%. There's our reserve ratio. Now we'll look at the table. If it's between 8% and 9.9%, our contribution rate is 4.5%. So let's try that one. We had 5.5 before. Hey, there we go. Now, the second part of this problem is what happens if they decide they're going to make some additional contributions? That sounds much more complicated to figure out than it actually is. So if they made, if the other way around, if $2,000 of additional benefits had been charged, so some employees drew $2,000 more of benefits, and it was charged by mistake, let's see, what would be the rate for 2024? That would be one of those instances where you would appeal the rate. But, so which of these numbers are we only have to change one number in this equation. Yeah, contributions paid out. Exactly. So, oh, no, I'm sorry. That's contributions paid in. I should do this. In, out. So we're going to change this number, the benefits paid out. So 2,000 more in benefits were paid out. What does that make this number? Yeah, 17,100. This stays the same. This stays the same. But now we just do the math. So minus 17,100.9 equals divided by. That makes our reserve ratio now 5%, right? So we look at the table. So if your reserve ratio is between 0 and 7.9, now your contribution rate is 5.5%. Makes sense if you think about it, because they paid out more in benefits. Their account is lower than what it was in the first calculation, right? Because they paid out more in benefits. So the balance is down. That means that going forward, they're going to have a higher tax rate. They're going to have to make that up. They're still in the black. I mean, they've still got money in their account. But if you look at the table here, so if contributions fell below benefits paid, so that means that this number up here is negative. They contributed less than what they paid out. Their contribution rate is just going to be 7%. But the higher we go down, the higher the percentage is, the lower that rate is. That's because that means our numerator here has increased. Either our contributions paid has gone up, or our benefits paid has gone down, or both has happened, right? I know that's several steps there. That's why I wanted to go through it with you. Questions? Thursday. I wanted to mention that as well. So your homework is due Thursday nights by 11:55. All right. Probably went a little bit over here. Let's look at, I already showed you this, and the deposits, that's pretty quick. So let's show you, let's take a look. I'm going to start this over.